The Financial Services Authority has published its new code on pay for the banking sector. It comes into effect on the 1st of January, and the new rules mean that within major banks and financial institutions, at least half of all bonuses should be paid as shares and not cash. The previous code only applied to 26 banks. However, 2,700 firms, which it regulates, will have to abide by the new revised code. But only the biggest banks must comply with all the guidelines according to the FSA. Well, with more on this, Chris Roebuck is from Cass Business School and he joins me now. Some people are saying that these bonuses are the toughest anywhere else in the world. Do you agree with that?
In terms of what's happening in Asia, in terms of what's happening in the US, yes, these rules are pretty tough. But to some degree, in terms of the top quality organisations, those banks have been paying their bonuses like that for a number of years. Because the idea of saying to somebody, you can't have the cash up front, you have to be committed to this institution, is something that they want to encourage themselves.
How much is this about the government being seen to kind of put pressure on the banks to moderate their bonus payouts, do you think?
It's a combination of trying to get the banks to moderate those bonus payouts, but also to try and encourage those organisations that aren't making people think long-term to make those people think long-term. Because the last thing the government wants is short-termism, which might initiate the sort of behaviour that we saw that previously caused the crash.
Is it going to work then, do you think?
Yes, because in the terms of the leaders of these banks, their whole objective is to have a sustainable business that can keep producing benefit for shareholders, for employees, and by virtue of that, tax revenues for years ahead. These people aren't short-termist. What they want to do is to have something that continues after even they've left. The people who are the traders are the ones that tend to think short-termism, and as long as their pay is controlled such that they are not allowed to get away with real short-termism activity, then it will work.
OK, what about investors then? What are they thinking if they're seeing that, payouts might be curbed? Surely it's in their interest to make sure that these firms are doing pretty well.
Yes, and from the investor's perspective, that's what they want. They want good performance from the organisation over a long period of time. But also from the investor's perspective, don't forget that when a bank makes money, it either goes to the investors, or it goes to the staff, or it potentially goes to the government in terms of tax. And it's how to balance those three particular interest groups that is critical in the future.
Chris, thank you very much. Chris Roebuck there from Cass Business School.